We'll be going over IRS Form 2220, Schedule A. This schedule contains both the adjusted seasonal installment method and the annualized income installment method, both of which we'll go over separately. Part 1 contains the adjusted seasonal installment method. Part 2 contains the annualized income installment method. And then in Part 3, we calculate the required installments that will then inform what we need to put into line 10 of the actual form itself. So again, these are different types of installment method calculations that you can use for a corporation or a business entity that has irregular seasonal or annualized income. So for example, you're not being held liable for an income tax penalty for estimated tax if you don't receive if you only receive most of your income in the latter half of your tax year. So that's not a fair imposition for a corporation or any taxpayer to pay taxes on a regular estimated tax basis if they have not actually realized that income. So in Part 1, you can see we've already pre-filled this form. I'll kind of walk you through, and then I'll kind of tell you how I've simplified it just for illustrative purposes. So for lines 1 and 3, you'll actually enter the taxable income for certain periods of tax years. So in line A, we're focused on tax year 2019, for line 1B, 2020, and then line 1C, 2021. And in column A, we're going to put in the first 3 months of income, the first 5 months in column B, the first 8 months in column C, and then the first 11 months in column D. So then we're going to enter the taxable income for each period of the tax year beginning in 2022 to kind of compare this to previous years. Now in this illustrative example, I've put everything as the same. I think there's an extra 0 that's warranted there. And I did this just so that you can visualize this instead of worrying too much about the calculations themselves. So basically, 2022 looks identical to the previous tax years. And now in line 3, we're going to enter taxable income for the same periods except for the same 2019, 20, and 21 tax years, except we're going to do the first 4 months, the first 6 months, the first 9 months, and then the entire year. And so I put in different figures. So, $150,000, $300,000 in the first 6 months. First 9 months would be $900,000, and then the entire year is $1.2 million. And again, I misplaced a 0. So we can kind of infer that the first 3 months there's an average of $33,000. Month 4 there's $50,000. Month 5 there's another $50,000. Month 6 $100,000. In months 7 and 8, somewhere in between there's all of a sudden a $500,000 jump. Month 9 it's $900,000. Month 11 there's 11. So the entire tax year looks like it's on average about $100,000 per month. But as you can see, the first 6 months are pretty slow. There's kind of a uptick somewhere between month 6 and month 9, and then it averages out after month 9. So we want to make sure that we're calculating the appropriate amount of estimated tax to account for those first 6 months where the income is lower than it would have been on a flat quarterly basis, and that we pick up that slack during months 7 through 9. So in line 4, we're going to divide the amount in each column on line 1A by the amount in column D on line 3A. So line 1A, and you know what, I pre-filled this with incorrect information, so bear with me while I rectify this. So this ends up being and then the amount in line 1A by the amount of 3B. Okay, so, or sorry, 1B by the amount in 3B, so that's 2. And then for this one, so all of these numbers are the same, so I'm applying them down, but my initial mistake was that I divided the amount on line 1A by the amount on no, that's right. Okay, sorry. I had this correct the first time, so yeah. The amount of on line 1B by the amount on 3B. Okay, got it. Okay. So I did do it correctly the first time. Apologize for the mistake. This will be okay. So in each column, and I thought I made a mistake originally, but I did not. So for column A in, let's say, line 4, you're going to divide 1A by 3A, and you get 0.6667. You would do the same thing here for line 1B divided by 3B, and all of these numbers are correct as I just verified them. For line 5, you will do line 1B by the amount of line 3B. So I did all of this identical so that all of these numbers are going to be reflective of the same calculations. In reality, your tax software would be spitting different numbers out, and the intent is to try and average out the previous 3 tax years so that you can have a baseline for comparing what this tax year's tax liability should look like based on the previous 3 years of annualized income. Okay, so all to say that when we average everything out, we basically get kind of let's say the same averages here are going to be reflected here, and then we're going to divide 2 by line 8. So line 2 is the $100,000. We're going to divide that by line 8. Annualized, that's right here, 150,000, 450,000, 600,000, and then here we've got, let me make sure that that is not a typo. Okay, that is a typo. It really should be 1.2 million. Okay, so now we calculate the tax based on the instructions for your Form 1120 or whichever is the applicable income tax return. So I pulled these numbers out of nowhere in particular. I just inserted the tax based on the amount here. From Schedule J, line 2, right? So, and then here I divided the amount in columns A through C by on line 3A by the amount on line 3A, so in column D. So for 2019, this would be 150,000 divided by 1.2 million. This would be 300,000 divided by 1.2 million. 900,000 divided by 1.2 million, and we've got the same results for lines 11, A, B, and C. And again, we're going to average these out. We're going to take the 3-year average, which basically is 1.25 or 0.125, 0.25, and 0.75. So in reality, all of these will be different figures. You're actually going to have to add them up, average them, based on real calculations. Once you have the average across the board, you're going to multiply the line 10 amount by the respective column number for line 13. So in this column, column A, 15,000 multiplied by 0.125, you get 1875. 25% of the 25,000 is 6250, and 37,500, and then $80,000. In column D, you simply just drop this amount down here. If there was alternative minimum tax, which applies to trusts only, then you would enter that here. You would also enter any other taxes for the tax period in line 16. So you wouldn't include certain taxes like personal holding company tax and interest due under the look-back method, or for completed long-term contracts, or for property depreciated under the income forecast method. You would use the same taxes for Part 1, Line 1. And then you'll add lines 14 through 16. Basically, we just carry those numbers down. And then for each period, we enter the same type of credits as allowed on lines 1 and 2C of Form 2220 itself. So if you recall in our previous video, looking at line 2C, we did have a tax credit for $1,000. Drop that down. Total tax after credits is when we subtract line 17 from, or line 18 from line 17. So that is calculating the quarterly tax requirement under the adjusted seasonal installment method. Now, we're going to take these numbers and we're going to apply them similarly to the annualized income installment method, except we don't need to average out the previous 3 tax years. Instead, the IRS publishes annualization period tables and annualization amount tables. Those are for lines 20 and 22. So in the form instructions, you'll actually see for corporations, they have 3 options, which is one is the standard option. You see this here on line 20. There's a little table in the instructions that say first 3 months, 6 months, and 9 months. There's also another option that includes 2, 4, 7, and 10 months, and option 2 is 3, 5, 8, and 11 months. For tax-exempt organizations and private foundations, there are just 2 standard option and then option 1. So the standard option would be 2, 3, 6, and 9 months. The option 1 would be 2, 4, 7, and 10 months. And again, those are on the form instructions. They're also in our article. So in here, line 21, we enter the taxable income for each annualization period, similar to, basically we kind of just put in numbers for the first, these periods of months. And then on line 22, we put in the annualization amounts from the respective table. And again, in the IRS website, there's a separate table for the annualization amounts. So for the standard option under corporations, those standard amounts are 4, 4, 2, and then 1.33 to the 5th decimal place. So make sure that you use the same option for the annualized period as you do for the annualization amounts. From here, it's simple mathematics. So you're going to multiply line 21 by the line 22 number, and 400,000, 400,000, 600,000, and then 1.2 million. If you had any extraordinary items, which we do not, then we would add them here. There is a breakdown of what extraordinary items look like in our article. So any item that's identified in Treasury Regulations section 1.1502-76B, a net operating loss carryover, Section 481 adjustment, or Section 481A adjustment, a net loss or gain from the disposition of 25% or more of the fair market value of the corporation's business assets, or any other item deemed as an extraordinary item in an Internal Revenue Bulletin. So you can look those up if they apply to you. They do not in this case. So we simply carry down these. Those are the total tax numbers. And then for each period, enter the same credits that were allowed. We put $1,000 across the board. Enter the total tax after your credits. 14,000, 24,000, 49, and 79,000. And then there's an applicable percentage that's auto-populated into here. And you simply multiply line 29 by this amount. And we've got our required tax payments throughout the year. So now we go to the required installment. If you only completed part 1 or part 2 of this form, you would bring down the respective amount in each column. However, since we completed both parts, we get a chance to compare them to see which one we would rather use. So in this case, we're comparing the 3,500 to the 875 up here. We're comparing this 12,000 to the 5,200, so on and so forth. By the time we get to here, basically we're pretty much evened up, but you can see that the adjusted seasonal installment method is preferable to the annualized income installment method. So we're going to use these numbers right here. So in the first part of the tax year, our tax liability is lower because we haven't realized all of this income. And then it's not until we get to here, the second half of the year, where the income starts to catch up. So we're going to use those numbers. We drop those down here. And then we're going to go column by column. So first installment, we in column A, we don't have any preceding columns from line 38. So we simply drop the 875 down here. And then you'll see in line 25, we've taken 25% of the line 5 number from page 1, which happened to be $80,000. We applied that across the board, 20,000 in every quarter. So we bring that down here, and then the required installment happens to be the smaller of 875 or 20,000. So 875 is a smaller number. We bring this up here. Now for this second column, we're going to simply carry this number over, but for subsequent columns, you need to add the line 38 numbers for the previous columns. So we'll go down through second installment. We subtract the 875 from the 5,250. We applied that against, well, so we will drop down the $20,000, back out this 875 required payment from the $20,000 that was here. The result is $19,125. We'll add these amounts and we'll put $39,125. And again, we compare the smaller of these two. So again, the smaller amount is this amount right here. And now when we go up to the third installment, we're going to bring up the total of the 4375 and the 875, and we get 5250. In line 34, we're going to subtract the 5250 from the 36,750, and we get 31,500. And then we've got the $20,000 as a placeholder in line 35. In line 36, we're going to subtract the 4375 from the 39,125, and we get 34,750. We're going to add that to the $20,000, and again, we're going to apply the smaller of the two. So in this case, the smaller of the two is 31,500. So now we add 31,500, 4375, and 875 to this right up here, the 36,750. Again, we're going to subtract line 33 from line 32. We get 42,250. Then we're going to have the $20,000 from line 5 here. We're going to subtract 54,750 and 31,500. We get the 23,250, to which we add the $20,000, and our tax payment is 43,250. It's still smaller up here, the 42,250, and that's the number that we're going to use as a required payment. So now that we've got our required payments, based on taking the better of the annualized income method or the adjusted seasonal installment method, now we're going to take those numbers and we're going to substitute the required installments here. So these numbers were 25% of the line 5 number. We're going to replace that with the numbers that we came to on line 38 for each of those. And again, this is the Form 2220 that we previously filed, right? So we'll go through this and we'll apply these same estimated tax payments to see if there's a penalty at all. So $875 was the required installment. We paid $15,000. So instead of the underpayment of $5,000, we end up with an overpayment of $14,125. So now we go up to column B. With our required installment of $43.75, we paid $35,000. So we're going to bring the $14,125 up here. We're going to add lines 11 and 12. We get $49,125. We're going to add any amounts from 16 and 17, and we don't have any. So we're going to subtract line 14 from line 13. And then if the amount on line 15 is 0, then we would subtract that. It's not. So now we have an overpayment again. We're going to subtract the line 10 amount from the line 15 amount, and we get an overpayment of $44,000. So basically what we're saying is we paid $50,000. Our total tax for this point was about a little over $5,000, $52.50. So we've paid $52,000 or $50,000 against a realistic tax bill of a little over $5,000, as opposed to the straight quarterly method where we were actually underpaid for the first quarter because it was just $20,000 across the board. So now we go up to column C, and we've got the $31,500 payment. We're going that's the required payment. The estimated tax, we paid $15,000. We're going to enter the line 18 amount here, so $44,750, and then we're going to add those. So that becomes $59,750. And then, were there any amounts on 16 and 17 before? No. So now we're going to subtract line 13 from 14 from line 13, in which case there's nothing to subtract, so we just carry that number down. There's a 0 here, and there's still an overpayment, right? So we're going to subtract the line 10 amount from line 15, and we still have an overpayment of $28,250. Okay, so it's not as much as the overpayment here, but we still have an overpayment. Now we have a pretty big installment due in the second quarter, or in the fourth quarter. Let's see how it matches up. We paid $15,000 into that, and now we're going to enter the amount from line 8 here. So that's $28,250, and then we're going to add those $43,250. Nothing from the underpayment side, so now we're going to drop this down. And so our overpayment actually is $1,000. However, we can't put that in here. You can just compare that we needed to pay $42,250. We actually came in a little bit above. But the more important thing is that line 17 is as clean as a whistle, which means we do not have to calculate this penalty on part 4. And this penalty that was $281 no longer applies because we used an alternate installment method. So that's all we have for Schedule A of IRS Form 2220. As I mentioned in my previous video, we've broken this down plus Tax Form 2220 itself. You can check out our article on teachmepersonalfinance.com. Simply go to the search bar and type in IRS Form 2220, and you'll see the walkthrough on both the tax form itself as well as Schedule A. And we'll have links to both of these videos in that article, and there's a comprehensive step-by-step breakdown of everything that you need to know. If you like our articles, please subscribe to our newsletter. If you like our videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the comments section. Thank you very much and have a great day.